Moving averages represent the average price of an asset across a specified time period, with that average price typically displayed as a line on a price chart, like this. There are several types of moving averages, including the simple moving average, the SMA, the exponential moving average, the EMA, and the weighted moving average, the WMA. Each type has different calculation methods and can provide some unique insights, although there is an argument as to how much of a difference using one type over the other actually makes. So in simple terms, moving averages help filter out the noise and random price fluctuations of an asset, making it easier to assess potential trading opportunities. As a really basic example, this yellow line is the 200 MA, representing the average price movement for the last 200 periods for this particular time frame, which being the weekly equals a line based on data for the last 200 weeks. And because it is clearly pointing upwards, we know this asset is firmly in an uptrend, which is information we can use to trade off. The first thing you need to understand about moving averages are the common periods used. Typically the 21, 50, 80, 100 and 200 work well across a variety of different time frames, with day traders obviously gravitating more towards the lower periods, even lower than the 21, whilst long-term investors will pay more attention to the 200. And obviously moving averages for each period are different for each time frame being viewed, as the 50 SMA on the hourly only represents the average price for the last 50 hours on that time frame, whereas on the weekly chart, which we were just looking at, it would represent 50 weeks worth of price data. But you can lock a specific moving average from one time frame onto another to help with your multi-time frame analysis, but more on that later. I also mentioned the differences between the simple, exponential, and weighted moving average types. Simply put, if you're trading the shorter time frames, for example, you're a day trader, the exponential or weighted moving averages tend to be better, as recent price data carries slightly more weight for the underhood calculations for those two types, as opposed to the simple, which is more laggy but better for long-term analysis. So moving to a price chart now, this is Bitcoin daily chart. We were previously looking at the weekly chart. And on the daily chart, that means that this, the 200 SMA, represents the average price movement for the last 200 days. So as we've established, moving averages can work just like support and resistance levels. So you can very simply wait for a breakout. If you zoom in down here, we can see we had a breakout of the moving average here following a dip, and this was back in May 2020. So this was the pandemic crash down here, and of course then the price action breaks above the 200 MA on the daily, and then traders would be then looking to enter on the retest of the 200 MA, and if you had done that, you would have ridden the price all the way up. But obviously, in order to know to exit your trade up here to maximize your profits, you're going to, of course, want to incorporate other technical analysis and trading techniques to ensure you're maximizing your gains. But really straightforward, the price action breaks above the 200 MA, you can then enter on the retest, ride it up. And very simply, when the price action breaks back below the 200 MA, you can then exit on the bearish retest, and that would essentially have given you a solid 400% profits over the space of 1 year. And then of course you can rinse and repeat when it breaks above it again, but you've obviously got to incorporate this with your knowledge of what's going on with the wider market. So again, you've got the break here, you could enter here. We're only going to get minimal profits, that's about 15% profits, I think, yeah, about 15% profits here, as essentially this first move above the 200 MA was a bull trap, but its next break of the 200 MA is more fruitful, and that would have given you 50% profits on that break. But again, that would have to be incorporated with other strategies in order to capitalize on those profits, because if you had waited for the price action to come back down and put in a bearish retest again of the 200 MA, you're only probably really breaking even if you enter here and essentially exit here. So obviously you have to use moving averages in combination with wider market signals, but that's a basic way of how you can trade them. In addition, they're great places to put stop losses. So if we go back to our initial entrance here, So I've been waiting for the price action to break above the 200 MA. We get this candle body close, and I'm looking to enter on the retest here. This is great, I'm excited. But where do I put my stop loss? Well, obviously the 200 MA also is a great line in the sand for your stop loss to sit underneath. So here's another support level. So I'll probably be doing that in just good practice, but there might be my stop loss, and obviously I could adjust my stop loss to trail this moving average all the way up. So if it does break through the 200 MA, then of course you exit your trade, no sweat. Here we go. So you can do that. That's how you can use stop losses and incorporate it with moving averages. Lots of different techniques, but it's another line in the sand you can use to trade off, and you can program trading bots to enter or exit your trades based on the break of the 200 MA in either direction. Essentially what we're trying to do is we're trying to enter the market as close to these moving averages, these long-term moving averages like the 200 MA. So we're entering the market when it breaks above the 200 MA and then retests it, and then we're exiting the market when it breaks below it and again puts in a bearish retest. And if you're essentially seeing this huge run up from Bitcoin and you're like, I want to get in on the market, but you see this huge distance between the moving average and the price action, that tells you that this is not a good place to enter, because you want to be entering again as close to the moving average as you can get in whatever direction you're trading. If you are essentially longing the market when the price action is up here, so far away from the support of the 200 MA, or you're looking to short the market when the price is down here, that doesn't make any sense. You want to be buying when it's close to the moving average on the upside, and then sell when it's close to the moving average on the underside. That's how you do it. So for long positions, you're essentially looking to try and get in around this area here, or maybe this area here. And then for short trades, you're looking to enter around here, or again around here, or around here. And that's principally how it works. Of course, you've got to be looking out for bull and bear traps, but principally this is just a basic way of how you can use moving averages to improve your success rate. But what other signals can moving averages provide? The golden cross is a bullish chart pattern used by traders and investors where a short-term moving average, the 50 SMA as seen here, crosses a long-term moving average, the 200 SMA, from below. This is seen as a bullish signal by traders, and long traders will often look to enter a position when a golden cross occurs. Obviously, the higher the time frame, the more significance a golden cross has. Now, a death cross, on the other hand, is the exact opposite and is the bearish equivalent of a golden cross, where a short-term moving average crosses a long-term moving average, this time from above. In addition, it's important to remember that the 200 MA or 200 simple moving average, which we've been looking at, is the most widely used period in trading for bullish or bearish indications. The 200 MA on higher time frames at least can function as strong support and resistance for the price action, the line representing a key place where buyers and sellers congregate, with even automated trading bots being programmed to buy and sell on the breaks of the 200 MA. I won't necessarily have all of the moving averages constantly displayed on a price chart, the key periods, but I will with the 200 MA, as it's too important to ignore when planning a trade. Now, how you color each moving average is obviously up to you, but having a system you can interpret at a glance should always be your aim. Hence why the 200 MA on my price charts is always bright yellow, as it needs paying attention to. It's also worth noting that a bull market is typically considered to be in play when the price action of an asset is above the 200 MA on the 1-day time frame, and that it's considered to be a bear market if the price action is below the 200 MA on the 1-day. So here now we have the most recent price action for Filecoin, and as you can see, we've got most of the typical moving averages displayed. We've got the different periods, the 21 in white, the 50 in red, the 80 in purple, the 100 in blue, and of course the 200 MA in yellow. So how do we incorporate moving averages into our trade planning? So let's just dig in a little bit. Obviously, there are plenty of moving average indicators to choose from. You can just type in moving average and some of TradingView's free ones will turn up. And you've obviously got more specific ones for, say, if you want one for the 50 MA, you've got other ones you can pick. So where do we start? Like with all trades, we zoom out first to get a look on the big picture and where we are. So this is the daily chart, just having a look at what's going on. Okay, big picture. All right, so I can see the big picture, mark up, mark down, consolidation, accumulation, it's all good, everything's fine. Here we go. So just mark on some key trend lines. This is the price data since 2022. So has it got a key trend line here, which we're knocking on at the moment. Got another trend line here. Here's the bottom, essentially. Okay, and we've got another trend line here. Let's add this one as well. This is, I'm thinking, that's about it. So we've got all our key trend lines. Now let's see what the moving averages are doing. So I'm going to enable the moving averages on this chart. Okay, good. So firstly, I always tend to, as I've said, I always want to see the 200 MA first. So currently we have broken out above the 200 MA on the daily, and now we're in the process of retesting, which looks like a potential double bottom here and here right on the 200 MA. So the premise of this potential trade now would be we've broken above the 200 MA and this is the retest, and we've also potentially got a double bottom forming. So this level here would be a nice point of entry, and because we've got the 200 MA on our chart now as well, this support line here at 4.578 is now supercharged, because essentially we've also got a lot of buyers which are going to show up for the retest of the 200 MA, which is running in parallel just below. So for me, I'll be wanting to get in maybe at around here with the price action, maybe coming back down and doing this, and then away we go. So that would be the premise of my trade. Let's just make that green so we're clear that it's good. Okay. And for my stop loss, the 200 MA is acting almost perfectly as a stop loss. So I could put my stop loss just below the 200 MA like this, mark it in red so I know it's my stop loss, and just check my risk and reward. Here we go, let's have a look. So my potential target is at least here. So yes, I got my stop loss, I got a good risk reward ratio of 5, that's okay, that works for me. So there we go, happy with that setup, as the 200 MA has not just helped me find a good entrance point, having a lot of support Confluence, it's also helped me find a comfortable place for my stop loss to hide behind, which is of course good trading practice. But additionally, do not of course neglect the other periods, because as you can see, the price action is also reacting to the 21 moving average as well. And additionally, you can see the 50 also acting as resistance to the price action, and the crosses between them also can provide helpful signals for long or short setups. Moving averages can be traded just like any other support and resistance levels, but with the understanding that not all moving averages are created equal, with longer periods carrying more weight than shorter. Moving averages can also serve as excellent entry and exit points for your trades. Entering a bullish move on the retest of the 200 MA typically reaps rewards, and taking profits on the bearish break of the 200 MA can also help ensure you lock in gains well in advance of less savvy traders. And locking a moving average such as the 200 MA to one specific time frame, such as the daily chart, can really level up your trade planning and your ability to analyze multiple time frames at once, and to see how the moving averages for each time frame interact with each other and the hidden insights that provides. Or even just being aware that if the 21, 50, 80, 100 and 200, or whatever periods you prefer to use, are all pointing towards the right direction and in the right order, it is the most basic signal you can get that you're in a strong uptrend or a strong downtrend, which in a sea of volatility can provide helpful clarity. But that's it for now. This has been a brief introduction to moving averages in crypto trading. Catch you in the next one.